Oil steal or oil deal? Welcome to today's episode of Energy Shots, where we've got a lot to discuss. Kevin, we're back not even a week ago.
It's amazing to think it's been fewer than 7 days since U.S. forces extracted former Venezuelan President Nicolás Maduro. And all the conversations we've been having, really, a lot of things have happened since then, Joseph.
They have. And I want to talk both today about what has happened and where we think this may go. Right? So the U.S. military, and under the direction of the president over the last week, has been on a seizure campaign. Mm-hmm. The Navy SEALs are grabbing oil tankers out of the North Atlantic, Russian flagged, carrying sanctioned oil. We seized Maduro early in the morning last Saturday using Delta Force, and the president is imposing his will, and perhaps the will of the United States on the country of Venezuela, and he has not been shy about the fact that oil is at the heart of this story.
And really, there's two threads to that story about oil. One is the existing barrels and their disposition. And the second is the investment in future barrels, production in Venezuela that could come out with a lot of investment in the near term.
Well, our audience has heard this a lot. You and I have discussed this before. We have to start with the fact that Venezuela holds the largest claimed proven reserves of oil globally. The other major candidates in that, the only other competitor in that game really is Saudi Arabia.
Yeah, on a reserves to production ratio, though, of course, Saudi Arabia has a different multiple because they're doing a significant amount of oil out of the ground. And what we have in Venezuela with 300 billion barrels of reserves is less than 1 million, with an M, barrels per day of production. That's down from more than 3 million barrels per day in the 1990s. And in the 1990s, Petróleos de Venezuela, the state oil company, envisioned getting above 6.5 million barrels per day over the course of the coming decades. And so a lot of geologic potential, not very much actual, and that's why we've seen relatively little movement in oil prices. We've seen a lot of interest, though, in where this could go.
Yeah, to me, the geopolitical story here is actually much larger than the immediate market story. But what I think the president is saying, we're going to rebuild the industry. The United States, and when he says we, he means the United States government, it looks like at this time, is going to help and then benefit from the revitalization of the Venezuelan oil industry. A second opening, I think, given what we saw in the 1990s post-nationalization. They brought in private companies, a lot of them from the United States, and international operators under joint ventures to grow oil production out of Venezuela that into the 2000s and early 2000s. After all that was renegotiated, expropriated, that's when you saw the industry fail.
Well, yeah, that and, of course, the collapse in oil prices that followed the Great Recession, which helped to undermine the use of PDVSA's proceeds for non-oil purposes, using the National Oil Company as a piggy bank instead of putting the money back into the ground. But you mentioned, actually, a couple very important concepts. On Sunday shows, Secretary of State Marco Rubio used the words guarantees and conditions to describe incentives that would be necessary for U.S. investment. One of the open questions to be uncovered over coming weeks is what those will look like, how will they be structured, and whether or not they would motivate oil company investment.
Well, let's talk a little bit right now about what could that actually look like, right? So, we have a ton of oil in the ground. We know that political stability, which they're pursuing by kind of threatening the existing remnants of the Maduro's regime and saying, like, our way or the highway, or our way or the extradition flight. But let's talk about what the market would need to see, right? What is the characteristic of Venezuelan oil that's most important for people to understand when we think about growing production out of the country?
Well, it's mostly that it's heavy and sour. It's of high density and a high sulfur content, which means that it needs more processing, not just in the refineries that buy it, but also it needs more processing before it can be sent to those refineries. And that means fairly significant capital investments will have to be undertaken to get the kind of growth that's being talked about. And those capital investments will depend on stability and the structure of that transition you mentioned.
And are those capital investments exclusively in Venezuela, or are we also talking about capital investments so that the global market can absorb more of this heavy oil?
Well, both, actually, and I think that's where this slide comes in. So timely, Joseph, how you've done that. So if we look over here, what have we got? We've got the share of global coking capacity. That is the ability to process this heavy, dense oil in refineries in destination countries. By country, the share, 41% of global coking capacity last year resides in the United States, close to Venezuela. Not even close. The next number 2 is China, and then India behind it, Russia, Saudi Arabia. So where is this oil going to go if we have a significant incremental production growth? You probably are going to at some point need significant incremental refinery capacity growth. Right now, though, there is capacity, and I think we'll talk about that in a moment.
Yeah, so if you think about, like, I want to talk about the long term and then talk about the immediate. And in the long term, if you need to expand this kind of coking capacity so that the world needs more or can use more of this heavy oil, the places where you might look to build it are going to be the United States, China, and India. And given that you have this capacity in China and India, this explains why under the sanctions regime, the sort of paltry flows out of Venezuela, they've been going to these 2 countries.
Well, yeah, and also China had both equity investments in oil as well as debt repayment oil barrels that were delivered from Venezuela. But when you get right down to it, the barrels are going to flow when there's a market. And so sanctioned barrels, distressed barrels find markets, usually at a discount for the selling country. But here in the United States, we spent tens of billions of dollars to sour up and heavy up our refinery kit to be able to process the kind of oil that Venezuela produces. And what you have here is Pad 3. Pad 3 is the Gulf Coast. So using the EIA's Petroleum Area Defense District designations, Pad 3 reflects where most of the refinery capacity is in the United States, the center of it, and heavy sour crude imports as gauged by the EIA. What we're looking at is the total volume from 4 basic regions. And so Mexico, which produces a heavy sour crude called Maya, which has been in decline over the years. Canada, which has a lot of heavy sour oil from the oil sands, which has been growing over the years. And Venezuela in the yellow. And what you can see is at the onset of January 2019, petroleum sanctions on Venezuela show the Venezuela fraction going to 0. Red is the rest of the world, the other heavy sour sources. And what you can see over time is that even when Venezuela starts to come back in November of 2022, when former President Joe Biden created some sanctions relief, the expansion takes us back to maybe halfway of where we were at peak. So what happened in those refineries? What were they running instead of the heavy sour crude? They had the equipment and the kit to process it, but the price they had to pay to get it, the limited supply that they had available, meant they were running other things. One of those other things, when you come from between here and here, includes Russian crude, which of course became problematic itself in 2022. So what you were looking for is the refineries that are equipped to optimally and efficiently process this heavy crude to high-value products that we all use, gasoline, diesel, fuel, other things, lubricants. They are looking for these barrels, and these barrels may be coming back.
Now, one of the things we've seen in reporting on this issue, in political statements, is concerns about the conflict between increasing Venezuelan production and imports into the United States, because we've got the refining capacity to absorb it, and both Canadian resources and domestic oil production. How much is that, in your view, is a real conflict that producers in the United States and Canada are going to be thinking about?
Well, downstream refiners are definitely going to be interested in having more heavy sour available. It either means that they'll have an opportunity to source more, or perhaps they can exert more price pressure on other suppliers, including Canada. But then there's the question of what additional barrels mean to the oil price, which is now at about $60 a barrel. And there's a lot of producers in the United States who say, wait a second, if you're adding more oil to a market that is already looking oversupplied, that's not that good for us. Now, in terms of oil quality relative to refinery complexity, which is what we've been talking about, of course, there are different barrels from different places. The U.S. light sweet barrels going to export are not necessarily in direct competition over the short term with the heavy sour barrels that could come in. But generally speaking, expanding the slate of petroleum globally, no matter what grade you add, is going to bring prices down, all other things being equal, and adding heavy sour barrels is going to create new opportunities for the downstream.
Right, correct. Now, I want to talk a little bit about what this might actually look like. Whoop, excuse me. I got so animated about this issue that the animations have betrayed me, Kevin.
This is how you can tell this isn't being produced by AI. For those of you watching at home, this is authentic. That is a real Joseph. This is a real Kevin. Carry on.
So I think here's the concern, right? So folks will look at this situation and say the U.S. is taking this oil. We're using it for our own benefit. It's not going to benefit the Venezuelan people. It might cause conflicts with producers domestically. It might create problems for the Canadian market. Let's actually talk about what this might look like. You and I have worked up a scenario, kind of roughly looking at what has been happening to distressed Venezuelan barrels to date. And if you were to bring those back toward market prices, if sanctions were to be relieved over time because the U.S. is confident that the Venezuelan government is acting in accord with its goals, what might that turn into? Walk us through the scenarios.
Well, Joseph, this gets very interesting because it starts on January 6th when the president puts on Truth Social that the U.S. is going to receive between 30 and 50 million Venezuelan barrels for sale and imported it into the United States. And then the next day, the Department of Energy and the Energy Secretary, Chris Wright, come out and say that this is going to continue indefinitely. The U.S. is going to be marketing and selling above board the barrels that were previously sanctioned. And so through a combination of both military might running a quarantine on the exports of those barrels via sanctioned shadow vessels, as well as economic force projection, effectively putting a sanction in place that forces these distressed barrels into discounted sales to markets of last resort, you have this ability to lift the price for those distressed barrels, selling them through conventional means through sanctions relief. So let's assume on the left-hand side, these distressed barrels, 400,000 maybe going to China, for example, at $30 a barrel, just a conversation point, not necessarily an actual price, generates $12 million per day in revenues. And so Venezuela is currently taking that in this scenario. If, on the other hand, those barrels could be sold at something closer to the market price for a heavy sour grade, maybe $55 a barrel over a medium term, now you're generating $22 million a day, and suddenly the very same number of barrels create more dollars. Those dollars can go into an escrow fund for shared U.S. and Venezuelan purposes, which the president did outline. The Secretary of State and Energy have outlined in ensuing days. And Venezuela could still theoretically take the same share. So essentially the mechanism of action here is to be able to change the price of the barrels by changing the sanctions circumstances, and while also maintaining strict controls over the disposition of barrels from Venezuela to enable this.
So, if you change the political story and you bring more of this oil into what I'll say is the sort of the market-driven pricing regime as opposed to the sanctions-driven pricing regime, you'd see higher sales values on these barrels, more revenue associated with them, and then one of the challenges, this happens in the corporate world, it happens to the federal government, is when you have more revenue, it goes away quickly. But we've even sketched out here a reasonable scenario where you have the same share going back to Venezuela as baseline, and then you've got an escrow account, which the president has said he wants to use both for the benefit of the United States and the Venezuelan people.
Yeah, we don't know what the actual terms will look like. We are still waiting to hear about conditions and guarantees, for example. And it's possible that all of the barrels sold might go through the United States, and therefore the disposition might look a little different in how it turns out. But there is theoretically a cooperative surplus generated by this mechanism of action that could be split and divided.
And does this kind of scenario, how does that affect the balance of the different constituencies we've got here in the United States? So how do producers, how do refiners act, or how are they incentivized? Are they happy with a scenario like this?
I don't know about happy or sad. I think if you work in the oil industry, you probably keep your emotions in check, especially in weeks like this one. But if you look at where the additional volumes benefit the downstream, we talked about that already. The question is, what about the upstream? Is there something you could do with these revenues, for example, that would assuage some of the concerns of producers who are saying, wait, there's additional supply coming to a relatively saturated market. We don't feel great about that. And the answer could be yes. An interesting thing that Secretary Wright said at the Goldman Energy Conference, where he was speaking a couple of days ago, Wednesday, was that he thought that there needed to be more investment in the Strategic Petroleum Reserve, more refilling of the Strategic Petroleum Reserve, but he couldn't get the revenues out of Congress. They tried, and they didn't get very much, a paltry 171 million instead of the 20 billion he'd originally sought. But there might be another way. Well, Joseph, you on this very show, here on Energy Shots in October, said, what about using Venezuelan oil for the SPR? Now, there's some challenges putting Venezuelan oil into the SPR. It's heavy enough and dense enough, you might not ever get it out.
What's a chemical engineering detail between friends, Kevin?
Right, but there's another way. You sell those heavy sour barrels generate money, use that money to buy medium sour barrels that come from U.S. producers. And now there's an SPR put available, essentially downside protection on price for producers when the price falls below a threshold, as the Biden administration originally designed. Then you will buy barrels for the SPR, procure for the benefit of the American people, but also provide an incentive to produce at the upstream so that activity in the U.S. oil patch doesn't slow down as much.
So we can you move yourself toward a scenario where this revenue could be used in an escrow account clearly to the benefit of the United States and our energy security by refilling the SPR, which historical rates of refill say that you could do it about 100,000 barrels per day. The volumes and potential volumes we're talking about could easily cover those kinds of flows, but you're not necessarily expropriating resources under a model where things are selling at higher prices.
Yeah, if we were going to take our hypothetical $10 million a day, which, again, hypothetical, and devote it entirely to $60 barrel purchases of medium sour grades for the SPR, it'd be about 166,000 barrels per day, which is well within the parameters for fill rates. That's historically, since the refill began, we've had that a few times, a few months. The nameplate capacity of the SPR is much more above that, but for technical and practical reasons, probably they wouldn't get much above 200 or 300,000 even at peak. But yes, we could absolutely do that. So the disposition of existing oil. Now, to be very clear, the Secretary has not said he would do this. Here on Energy Shots, we explore ideas, we talk about data, we consider concepts, and I think sometimes bravely predict, often accurately, it seems. Great prediction from October for you. But there's also the future barrels discussion, which I think is still pretty important.
Well, and that's where we wanted to kind of close our discussion today, Kevin, because we're having this conversation on Friday morning, Friday afternoon. Oil executives are meeting with the president in the White House to talk about what this reopening might actually look like. How are we going to get investment into Venezuela to increase barrels and achieve, if not what we've talked about, a similar kind of scenario? What's your read on what we might see this afternoon?
Well, I think it's going to be a complicated meeting in a lot of ways. A lot could change between now and then. For example, the Supreme Court, sometime shortly after we finish this podcast, could decide that the president's tariffs are illegal using the International Emergency Economic Powers Act. That might make the president a little upset and could make a testy president looking very specifically for a win in the meeting. And last night on Fox News, and then early this morning, the president put out what he wants to hear from executives. He wants a magic number of $100 billion in investment. Now, I'm not sure what time frame or in what capacity he's looking for that number, but he's got it in his head that these very significant capital outlays are going to be necessary. I think that's true. And I suspect that he's going to want to hear that from the companies in some form when he meets with the executives this afternoon. For the executives, though, there's a couple of considerations. Practically speaking, first of all, you're going to want to know what the risks are and what the incentives and the reimbursement package might look like. You're going to want to understand that, because if you're making an investment in the corporate boardroom, you're making an investment based on the risk-adjusted return on invested capital. And before you make that investment, you're going to want to know what the risks and the return look like. And so I suspect they may want to say they are exploring or looking into it with great enthusiasm. Some of them probably have risk profiles, or they might even say yes outright. But for some companies who have been exerting a lot of capital discipline, showing that they've been minding their P's and Q's on spending, they're going to want to be cautious about telling Wall Street that they're going into Venezuela and going in a big way at $60 a barrel crude oil price.
And what do you think are the key things that oil executives, when they are meeting with the president, who's going to say to them, do it for the country, they're going to be looking at? Are they looking at global markets? Are they looking at coking capacity? Are they looking at just the ability to get on the ground and operate safely and responsibly? What are the key factors they're going to be considering?
Well, I think different companies are going to have different perspectives based on their history, based on their technology, and frankly, based on their sense of opportunity, what's in their portfolio and what they think they might be able to make use of. There's a lot of ways to play in this, too. It's not just a matter of getting into Venezuela and helping produce oil. There's diluent to dilute the heavy oil so that it can be moved to upgrading and export, selling that. Services, technology services to help upgrade and repair initially and then ultimately expand the Venezuelan oil patch. Very significant opportunity there. So different kinds of companies trading and marketing those barrels. Other companies are going to play a role in that. All of them will have different perspectives on it based on where they fit into the value chain and where they are in terms of individual risk profiles and portfolios.
And what's one last thing that you're watching as this situation develops over the next 2 weeks?
Well, it's interesting because Secretary Rubio laid out a three-phase plan, essentially of stabilization, recovery, and transition to democracy. And President Trump made it much simpler. He essentially wants to get the barrels flowing before the democracy gets going. But a lot is predicated on the oil industry recovery in Venezuela. And so understanding what those plans look like, the key dates and milestones, and the structure and sort of the concepts that are going to be brought to bear to encourage investment, I think is going to be extremely important.
Kevin, there's no person I want to talk about this issue more than with you and our audience here at Energy Shots. Thank you so much for joining me in this endeavor. Colleagues joining online, thank you so much for your viewership. We welcome your comments, we welcome your responses, and we'll see you next time on Energy Shots. We hope you have an energetic day.